This is a Commitment of Traders report, published every Friday afternoon by the CFTC. This document reveals the positioning of every major participant in the silver futures market, who's long, who's short, and by how much. For traders who know how to read it, the COT report is a roadmap of where smart money is positioned and where it's heading. Friday's report contained a number that I've never seen in 20 years of tracking precious metals positioning. Managed money, the category that includes hedge funds, commodity trading advisors, and institutional speculators, increased their net long position by 47% in a single week. 47%. From 67,400 contracts to 99,100 contracts. An addition of 31,700 contracts, representing 158.5 million ounces of silver exposure in 5 trading days. This isn't normal repositioning. This isn't trend following or momentum chasing. A 47% increase in managed money longs in 1 week is a categorical statement. It's the institutional trading community saying, collectively and with real capital, that silver is going dramatically higher. They made that statement while silver was breaking through $95 per ounce, a price that seemed impossible 18 months ago, that seemed optimistic 12 months ago, that seemed aggressive 6 months ago. $95 silver is now the floor that managed money is building their position from. The question everyone is asking, is $200 locked in? The positioning data suggests the answer might be yes, but the positioning data is only half the story. The other half is the industrial demand crisis that's making $200 not just possible, but potentially necessary. Here's what they're not telling you. Managed money doesn't move 47% in a week on speculation. They move on information. The funds in the managed money category employ analysts who track industrial supply chains, monitor refinery output, model inventory drawdowns, and calculate the price required to balance supply against demand. When managed money moves this aggressively, they're not guessing. They're front-running a price adjustment that their models say is coming. The question is what their models see that the broader market hasn't priced yet. The answer appears to be the industrial demand crisis that's been building all year. Industrial silver demand in 2026 is running 23% above 2025 levels. Not growing 23%. Running 23% above year-ago comparisons right now, with acceleration indicated in forward orders. Solar panel production has increased 38% year over year as the global energy transition accelerates. Each gigawatt of solar capacity requires 850,000 ounces of silver for cell contacts and interconnects. Global solar installations are tracking towards 740 gigawatts in 2026, up from 580 gigawatts in 2025, requiring approximately 629 million ounces of silver. That's 77% of total mine production consumed by a single industry. Electronics demand has surged 18% as AI infrastructure build-out reaches peak construction phase. Every data center housing AI chips requires silver for thermal interface materials, connector plating, and switch contacts. Microsoft's 50 new data centers, Google's 40, Amazon's 35, Meta's 28. The hyperscaler build-out is consuming silver at rates that didn't appear in any forecast published before 2024. Electric vehicle production continues growing despite the, quote, slowdown narrative. Global EV sales reached 19.2 million units in 2025 and are tracking toward 22.8 million in 2026. Each EV contains 25 to 50 grams of silver for battery management, charging systems, and electrical connections. The EV industry's silver consumption has increased from 38 million ounces in 2023 to an estimated 67 million ounces in 2026. Added up. Solar, 629 million ounces. Electronics, 147 million ounces. EVs, 67 million ounces. Medical devices, 28 million ounces. Industrial catalysts, 31 million ounces. Other industrial, 89 million ounces. Total industrial demand in 2026, approximately 991 million ounces. Global mine production, 820 million ounces. Recycling supply, 155 million ounces. Total supply, 975 million ounces. Industrial demand alone, before any investment demand, before any jewelry fabrication, before any silverware production, exceeds total supply by 16 million ounces. When industrial demand alone exceeds total supply, investment and jewelry demand must be satisfied entirely through inventory drawdowns. There is no production margin. There is no supply buffer. Every ounce demanded by investors or jewelers comes from stockpiles that are already depleting. This is the crisis that managed money's models have identified. This is why they increased longs by 47% in a single week. They see the arithmetic, and the arithmetic says current prices cannot hold. This is where the lie becomes unsustainable. The price that balances supply and demand when industrial demand exceeds total supply isn't $95. It's the price that destroys enough demand to create balance. Industrial demand doesn't destroy easily. Solar manufacturers will pay $200 for silver before they cancel panel production. The economics still work at $200 because silver is a small fraction of total panel cost. Electronics manufacturers will pay $200 before they redesign products to eliminate silver. Redesign takes years and costs billions. EV manufacturers will pay $200 before they substitute inferior materials. The reliability implications for battery management are too severe. The demand destruction required to balance the market must come from price-sensitive categories: investment buying, jewelry fabrication, and marginal industrial applications. These categories represent perhaps 350 million ounces of annual demand. To eliminate the deficit, prices must rise enough to destroy approximately 250 million ounces of demand, roughly 70% of the price-sensitive categories. The price that achieves that destruction isn't $95 or $120 or $150. Historical elasticity models suggest $180 to $220 is required to reduce demand sufficiently. $200 isn't a round number chosen for dramatic effect. It's the approximate midpoint of the range that industrial demand models indicate is necessary to achieve market balance. Managed Money's positioning suggests they've run similar models and reached similar conclusions. At 2:30 p.m. New York time on Thursday, Goldman Sachs published a research note revising their silver price target from $115 to $195 over 12 months. The revision, a 70% increase in their target, was attributed to structural industrial demand exceeding supply capacity with limited substitution potential. Goldman's commodity desk employs over 200 analysts tracking physical markets globally. Their models incorporate real-time data from miners, refiners, manufacturers, and logistics providers. When Goldman moves their target to $195, they're not speculating. They're reporting what their data indicates about where prices must go to balance physical markets. The note contained a detail that received insufficient attention. Goldman's models assume industrial demand growth moderates to 8% in 2027, down from 23% in 2026. If demand growth doesn't moderate, if solar build-out accelerates further, if AI infrastructure expansion continues, their $195 target becomes a floor rather than a ceiling. When positioning and fundamentals align, the move becomes self-reinforcing. Managed Money's 47% long increase isn't just a bet on higher prices, it's a catalyst for higher prices. The mechanics work like this. Managed Money buys 158.5 million ounces of paper exposure. To hedge, their counterparties, primarily bullion banks, must either sell silver they don't have or buy physical silver to cover the exposure. If they sell uncovered, they're naked short against a market in deficit. If they buy physical, they add to demand in a market already exceeding supply. Either response is bullish. Naked shorts must eventually cover, creating buying pressure. Physical buying depletes inventory, tightening the market further. The positioning becomes a self-fulfilling prophecy. The buying creates the conditions that justify more buying. At 7:15 a.m. London time on Friday, the LBMA silver fix came in at $97.40, $2.40 above the COMEX close from Thursday. The London physical market is leading New York paper higher, suggesting that industrial buyers are bidding aggressively for actual metal. When physical leads paper, the price trend has fundamental support rather than speculative froth. The physical premium over COMEX has widened to $4.80 in London, $8.40 in Zurich, $22.30 in Shanghai, and $54 in Tokyo. The premium gradient points east, highest where industrial demand is greatest, lowest where paper trading dominates. The gradient confirms that industrial buyers are the marginal price setters, not speculative traders. Less than 45 days remain before the May COMEX delivery period, which historically sees elevated delivery demands as industrial users secure physical supply for Q3 production. Open interest in the May contract is 287,000 contracts, 1.435 billion ounces of paper claims against registered inventory of 29 million ounces. A 49-to-1 ratio. If even 3% of May open interest stands for delivery, demands reach 43 million ounces against 29 million available. The delivery math that has been tightening for 2 years is approaching the point where normal settlement becomes impossible. While one side positions, the other side scrambles. The commercial traders, bullion banks, and dealers who typically run net short positions to facilitate market liquidity are behaving in ways that reveal their concerns. Commercial net short positions have declined from 89,000 contracts in January to 67,000 contracts today, a 25% reduction in short exposure, while prices rose 34%. Commercials reducing shorts into a rising market is a capitulation signal. They're covering positions because they fear the upside, not adding shorts because they expect mean reversion. At 9:45 a.m. Singapore time on Thursday, a major bullion bank, reportedly HSBC, though unconfirmed, began offering clients cash premiums to close out forward purchase agreements rather than take delivery. The premiums reportedly ranged from $8 to $12 per ounce, paying clients to accept cash instead of silver. This is extraordinary behavior. Forward agreements are contracts to deliver metal at future dates. The bank offering premiums to cancel those agreements is telling you they don't have the metal to deliver and don't expect to acquire it at prices that make delivery economical. When bullion banks pay clients to not take delivery, they're admitting that the physical market cannot satisfy paper commitments at current prices. They're buying time by buying out contracts. But the industrial users who need actual silver can't accept cash instead of metal. Their factories require physical supply. The cash-out offers will defer some delivery demands. They won't eliminate the fundamental imbalance between paper claims and physical availability. They'll simply concentrate delivery demands among participants who refuse the cash alternative, the industrial users for whom delivery is non-negotiable. This is what a market looks like before it reprices to a new equilibrium. The managed money positioning shows that sophisticated capital expects dramatically higher prices. The Goldman research shows that institutional analysis supports that expectation. The commercial behavior shows that market makers are reducing exposure rather than fighting the trend. The physical premiums show that industrial buyers are already paying prices far above COMEX quotes. Every indicator, positioning, fundamental analysis, commercial behavior, physical premiums, points in the same direction. The convergence is rare. Markets usually have conflicting signals that create uncertainty about direction. Silver has no conflicting signals. Every data point suggests higher prices. $200 as a target derives from the demand destruction required to balance a market where industrial demand alone exceeds supply. It's not a speculative fantasy or a round number guess. It's the output of models that calculate what price eliminates enough price-sensitive demand to create equilibrium. The timing is less certain than the direction. Markets can remain dislocated longer than fundamentals suggest. Managed money can increase longs further, pushing prices above $100 or $110 in the near term. Or profit-taking can create temporary corrections that test conviction. The path to $200 won't be linear, but the destination appears locked in by arithmetic that doesn't change based on sentiment or positioning. Industrial demand exceeds supply. That gap must close through either supply increase or demand destruction. Supply isn't increasing. Demand destruction requires prices that no current forecast includes. Some will look at $95 silver and see a bubble. We'll remember previous rallies that reversed. We'll assume that managed money is wrong or early or will be forced to liquidate. We'll trust that commodities always mean revert because they always have. These are the same voices that called $50 silver a bubble in 2011, then watched as the fundamental deficit that justified $50 grew larger every year. That called $30 silver overvalued in 2023, then watched as industrial demand growth accelerated beyond any forecast. The voices are always skeptical of prices that seem extreme. The prices keep rising because the fundamentals are more extreme than the prices. Others will download the COT report, will calculate what a 47% managed money increase implies about institutional expectations. We'll notice that Goldman raised their target to $195, while commercials cover shorts and bullion banks offer cash outs on delivery commitments. The informed are not predicting $200 silver on a specific date. Commodity markets don't respect calendars. What the informed recognize is that the positioning, the fundamentals, the commercial behavior, and the physical premiums all indicate the same destination, a price level roughly double current quotes, required by arithmetic that current quotes don't reflect. This is not financial advice. This is not a recommendation to buy silver at $95 or at any price. This is simply an observation about what the data shows. Positioning at historic extremes, fundamental demand exceeding total supply, commercial behavior indicating capitulation, physical premiums confirming industrial urgency. $95 silver isn't the story. $95 silver is the starting point. Managed money just increased longs by 47% in a week. Goldman just raised their target to $195. Commercials are covering shorts. Bullion banks are paying clients to not take delivery. Physical premiums in Tokyo are $54 over COMEX. Every signal points the same direction. Every indicator confirms the same destination. $200 isn't locked in by speculation, it's locked in by arithmetic. Industrial demand, 991 million ounces. Total supply, 975 million ounces. Investment and jewelry demand, 350 million ounces. Total required demand destruction, 250 million ounces. The price that destroys 250 million ounces of demand isn't $95, it's $200, maybe more. The market is figuring that out. Managed money increased longs 47% in a week because they've already figured it out. The question isn't whether $200 happens. The question is whether you figured it out before they did, or whether you'll be buying at $150, wondering why you didn't see it at $95.